For the last 3 weeks, we have had one of the most volatile stock market ever since the COVID crash in March 2020. There were many days where there's extreme volatility. The day could start at -3% across the whole market just to end at a positive note or vice versa. Now, despite this extreme volatility and a lot of panic selling, for this week, the market still ended at a slight positive overall. But compared to January 1st, obviously everything is still down quite a bit. Now, to add to the volatility, this week Bank of Canada and Federal Reserve came out and announced that they're going to hold their interest rate for the time being, making the next hike possibly in March. Now, Jerome Powell, which is on the US side, also spoke about the balance sheet runoff, which is going to be one of the concerns that we will address in today's video as well. So today's video is really going to be about interest rate hold. Why is it happening? When is the next rate hike likely going to be? Balance sheet runoff, and how do these things affect the stock market and the housing market, and how we should be preparing for them. Now, before we start, a quick reminder, if you haven't already, help us like the video and also join our private Facebook group if you want to get more exclusive info and also ask questions in that group. Alright, without further ado, let's jump into today's video. Now, before we start, just to preface, please do not take what I'm about to say as the gospel or it's really going to happen this way. All these are just my opinion. I'm probably going to be wrong on some of them, if not most of them. The truth is that nobody knows what is really going to happen to the stock market, to the housing market, to the interest rate hike. Nobody knows. So this is not financial advice. I'm simply sharing some of my readings online and my own personal opinion. And as always, before you do anything, make sure you consult someone, or at the very least, make sure that whatever you're about to do matches your risk tolerance and your investment timeline. Alright, so let's first address the topic of interest rate hike. Now, as we said, Bank of Canada and Federal Reserve have came out and announced that rate hold is going to be the thing for January, making the next rate hike as early as March. I have provided a link in the description below to their full statement, so if you are interested, you can check it out over there. Now, I know on this note, a lot of people I saw online is very upset that Bank of Canada is not increasing the interest rate to fight inflation and also fight the super high home prices. Now, I'm not saying they're doing a good job or bad job to fight inflation, etc. I'm not sure, to be honest. I don't know what is the best way to do things. But I just want to be fair here and say that for January to hold the rate, this is to be expected, and we can't really blame them for not increasing rate because in Canada, we can't increase our rates before the US does. In the history, we have only tried it twice, and both times we had to back down after we increased our rate before the US. The reason why is because if we raise rates before the US, hot money flows into the loonies, right? They demand our currency a lot more and make our Canadian dollars a lot more expensive. And us being an export country, this will significantly hurt our export. This is why Tiff Macklem has to wait for the US to do so first, and then we follow, so then our export doesn't get hit. So while not increasing interest rate doesn't help the inflation or the housing problem, it's also going to be a lot more complicated than just about these two. It's also going to affect the overall health of the economy and also whether some people will get to keep their job next month or not. So this is why they cannot increase the rate before the US. I just want to be fair and point that out. But other than that, we also know that January rate hike, it's very unlikely to begin with. As you see on the screen, this is what the overall market's guess of when the next rate hike and how much it's going to hike going to be, depending on Bank of Canada and Federal Reserve's meeting dates. As you can see, most people guessed it's going to be March to begin with 83%, and the raise is going to be anywhere from 25 to 50 basis points, which is 0.25 to 0.5%. Now, different banks also have their different predictions. As you can see on the screen, Goldman Sachs predicts 4 hikes, Deutsche Bank predicts 4, JP Morgan CEO did say 7, but I think he's just exaggerating. TD is doing 4, BMO is 5, RBC 3, and then Scotia is 3 to 4. So even though they just announced they're going to rate hold and maybe we're going to see it in March, they haven't really confirmed, please do keep in mind that rate hike, it's going to come. It's just a matter of time, but it will happen. Now, before we talk about the possible effects, let's talk about the second thing which the Federal Reserve and also Bank of Canada have on their sleeve, and that is to let the balance sheet to run off. So what is going on here is that when there is an economy downturn like 2008 or COVID, when everyone's getting hurt, the government wants to stimulate the market and the economy by pumping money into it. Doing so is going to stimulate growth and also have less unemployment and bring people out of the recession a lot quicker. Now we hear the terms of pumping money into the market all the time, but what is actually happening when they're saying they're pumping money? Well, what they're actually doing is they're massively buying into treasuries or mortgage-backed securities or other credits. And this is also called quantitative easing. Because when they do that, they're basically exchanging new money, right, hot money, in exchange for the bonds into the market. So government is going to hold the bonds while the market gets more money. Now, as they accumulate more and more bonds, the government's balance sheet will start to increase. They have more and more debt. As you can see on the screen, both Canada and US Treasury have significantly increased their balance sheet since COVID. And what that will do naturally is what you're seeing right now, which is inflation is starting to come up, and the government then will have to be pressured to do the reverse thing, which is to shrink the balance sheet. And this is also known as balance sheet runoff, which is the thing that most people are worried about nowadays. Now, to shrink the balance sheet, they can actually do two things here. Number one is they can sell bonds, so do the reverse. Instead of buying bonds in exchange for cash, they do opposite, which is they sell you the bonds and they hold more cash. Or the second thing is they can simply let the current bonds mature and then choose not to reinvest or repurchase these bonds. Now, they can do one or they can do both, but no matter what, they're basically just pulling money out of the economy. Now, during this week's meeting, Jerome Powell basically said that they're not leaning towards selling bonds, which is going to be very aggressive, but instead they're going to do the other thing, which is just simply stop buying bonds and let them mature and run off the balance sheet naturally. On top of that, he said this process is going to start only after they start increasing their interest rate. And finally, he said that treasuries is likely what they will be focused on holding, signaling that they are going to let other types of credit like mortgage-backed security to run off at a faster pace than treasuries. Now, even though market is volatile right now, most people are saying because of the increase in interest rate, while that does play a part, a larger attribution to the volatility is the unknown of when the balance sheet runoff is going to start and how fast it's going to shrink the balance sheet. This unknown and lack of guidance is really what's upsetting the market right now. Even in January's meeting, the Fed basically gave no estimation on when the runoff is going to happen. We only know that it is going to happen after they start increasing interest rate. Which means if most people are expecting the first rate hike to start in March, then the balance sheet runoff should happen somewhere around June or July. Also, we don't know how small the balance sheet they want to reduce it to. On the screen, you're going to see a simple projection of what the US federal balance sheet is going to look like at a different reduction rate. As you can see, even at 100 billion a month runoff, it's going to take us all the way until 2026 to get back to pre-pandemic level. But the truth is that the government cannot give too much of a guidance because they don't know themselves. Balance sheet runoff is actually a much more delicate process. For example, from late 2017 to fall of 2019, they were only able to reduce the balance sheet for about 15% before they run into trouble. So what happened during that time is the reserves that banks hold with Feds got too low, which spiked short-term borrowing costs, and the Fed had to do the reverse, which is inject money and inject cash into the repo market. Repo market is what banks use to borrow money overnight. And also one thing to keep in mind is balance sheet runoff is actually a natural thing. I know a lot of people online have been saying that, hey, these things, it's going to be like the Armageddon of stock market. Like it's going to tank everything and it's going to ruin the economy, etc. It's simply not true. Balance sheet runoff, like shrinking the balance sheet, expanding balance sheet, these things happen all the time throughout history. It's just what the government does. When we have pumped so much money into the economy, trying to save all the small businesses and most people from the devastating effect of COVID, eventually we will have to shrink the balance sheet. This is a natural thing. And on the screen here, you can see the balance sheet size of the Federal Reserve versus the S&P 500. And the first sight, it does seem it's pretty correlated. It could also make sense because if you imagine if money is leaving the economy, leaving the market, then it should hurt the overall market and things should fall. But for example, despite the taper tantrum that we saw in 2018, the market tends to trend upward from 2017 to 2019, despite the fact that the balance sheet shrinks during those times. And also before that, from 2015 to 2017, even though balance sheet held and did not decrease, S&P 500 actually traded flat for almost 2 years. Not much growth were happening. So while right now the market is being very scared and very upset because of the lack of guidance of balance sheet runoff and also interest rate increase, the truth is that when these things do happen, the actual effect, like will the market further tanks more or will it actually do the opposite and go up? Nobody right now will know what will happen until these things do happen. So then next, let's talk about, are they doing a good job to fight inflation? And also what should we be doing to prepare ourselves in terms of real estate and also the stock market? Now first, let's quickly discuss, will increasing interest rate combat inflation itself? In my opinion, raising interest rate will help somewhat in terms of fighting inflation, but I think the effect is going to be a lot smaller than most people expect. The reason why is because right now inflation is caused by two things. Number one is quantitative easing, which is pumping money into the market. We just talked about that. And also the chip supply bottleneck. So raising rates is going to help with the QE part of things, the pumping money part of things. But right now, most of the inflation, I would argue, is caused by supply shock to the chips sector. And no matter how much you increase interest rate, it's not going to help over there. Yes, by having a higher interest rate, it will make borrowing costs higher and make consumer demand slightly lower and less attractive to spend more money. But do keep in mind that not only a lot of people's wages did go up the last 2 years, they also saved a lot of cash due to lack of travel. Plus, as long as travel is not back to normal, online consumption is going to stay at an elevated level. Also, retailers will have a hard time reducing the price because, like we just said, supply is at a bottleneck. It won't magically disappear just because interest rate is higher. It's going to continue making it more expensive for retailer to import goods and transport them. There is going to be an elevated price floor for all items. And because supply is so constrained right now due to shortage, you can never raise rates enough to bring down the demand to match the low level of supply. Doing so will simply just tank the economy and crash the market right away. And this is actually very similar to the housing situation, especially in Canada. It's basically a smaller version of the world's problem of supply chain shock. Now, first of all, I believe that rent is gonna continue to inflate, especially as interest rate increase. Though there are rules in place for each province, like putting a cap on annual rent increase, owners is still gonna do their best to try to pass these costs to the tenants. We can see on the screen here, major cities' rent have already trended back to pre-pandemic level. So with higher inflation and higher costs, I really don't see rent to go back down. In fact, I do believe it's going to continue to trend upward. Now, on the other hand, let's discuss about home prices. What do I think is going to happen with a 1% increase? Long story short, I think for this year, despite a 1% increase possibly, or maybe even 1.25, home prices is still going to trend upward by the end of this year. However, there is going to be some internal adjustment and rebalancing of home prices, which I will discuss as well. So first of all, a 1% increase, let's say we do get there, is definitely going to deter some buyers, especially when it comes to the bigger properties where you do have to borrow above $1 million. So for that part, a slowdown or even a plateau overall can make sense, but I think it's very difficult to see a correction in home prices, and that's because just like the world's problem with the supply and demand, the imbalance between demand and supply is way too much for 1% to make a difference. Now I'm going to refer to a publication I read online previously, which is called Forecast for Failure, and in there it discussed the problem that Toronto was facing. Why is Toronto home price so high? Well, basically, it's to do with the last 10 plus years of incorrect forecasts of population growth, supply, and also demand. And in the end, it argues that right now, if we want to meet the current imbalance, Toronto needs to have at least 30% more new housing supply per year just to balance everything. Now, let's say interest rate increase and it can help us lower some demand. But how much are we really expecting from the 30% extra that we need? Let's say we no longer need 30% and it becomes 25% or even 20%, very optimistically speaking. Even at those levels, it's still near impossible to meet these kind of demands. First of all, if we look at new build perspective, winter makes breaking ground a time-sensitive thing, so we can't be starting new projects all year round. There's a more narrow time limit that we can start at. Also, obviously, COVID will slow down everything. Also, approval process is pretty slow and lengthy no matter which province you're in. On top of that, there are tons of fees and taxes to front before you even begin building. And lastly, since we have seen from 2020, global supply issue has made built material a lot more expensive. For example, lumber, it skyrocketed, 3-4 times than the normal price, which really delayed and deterred a lot of the smaller developers or independent developers. They basically have no incentive to build anything for the next 1, 2, 3 years until supply and everything go back to normal. So this is from the new build perspective. Now on the other side, I know some people argue that, hey, if we see interest rate increase, we're going to suddenly see a lot more supply from the existing home because people can't handle the mortgage payment. They're going to have to, sell their house early. While I do agree that we'll probably see more foreclosure, that is the logical assumption, the reality is that real estate is extremely inelastic. And it takes a long time before someone is convinced they are going to sell at a discount just to get out of their housing situation. Because we can flip the perspective, and let's say you own a home right now, you put 100K, 200K, 300K down pay into it, and suddenly the price may have dropped maybe 10%. Because you bought it in the recent 2 or 3 years, you know that at this price, if you sell it, you not only you can't break even, you might be losing some of your original down payment. Let's just ask yourself, will you be selling if you're in this situation, or will you be looking for other methods to prolong your payment until you really can't take it anymore, in hopes that maybe during those times your salary can go up, the house market can go up, so then you can walk away with a profit? You're probably going to delay as much as possible. So the reality is that the only people that will get affected to a point where they have to foreclose has to do something with losing their job suddenly, or they're going through some sort of marriage breakdown or special distress situation, which is going to be very rare and it's not going to affect the overall supply. And we have also talked about this previously in other videos. We've said that different experts have pointed out to really see a drop in demand significantly to a point where it starts affecting home price, we have to expect at least a 3 to 4% in the interest rate that people are paying before we see these kind of effects. And we can also look at that in 2018, where government have started to increase interest rate quite a bit. During those times, the average home price did plateau and even fell a tiny bit, largely due to, like I said before, bigger homes not selling well and they have to be sold at a bigger discount. But even during those times, the price were balanced out by condos going up significantly more than big houses, big detached home, just because they were a lot more affordable. So despite the increase in interest rate, young people were still able to go after these cheaper units. Now, however, this doesn't mean that everything is just going to go up for the end of the year. While the overall market, I think, is going to trend up, I do believe there is going to be some adjustments between the regions. For example, some places that have grown significantly due to work from home or other short-term factors may see some rebalancing in terms of prices. Now, I'm just going to share a little bit of my personal experience and observation. In Vancouver, I own condos in both Surrey and Burnaby, and I have just sold my Surrey condo in the beginning of January. So I'm seeing this happening to me, and it's really what's going on right now. In Surrey, the square footage for condo has grown significantly since December 2020, while Burnaby stagnates, as you can see on the screen. When we sold our Surrey condo, the price per square footage is fast approaching what it's worth for my Burnaby condo. Now, if you have lived in BC or Vancouver, you know that this doesn't make sense. You know that just from reputation or home prices point of view, Burnaby is supposed to worth a lot more than Surrey. It's much closer to city center. It also has, far less crime rate, etc. So we can argue that if price per square footage in Surrey is fast approaching what it's like in Burnaby, especially for condo, then I should expect this to be readjusted sometime soon. Either Burnaby has to go up or Surrey has to go down significantly to maintain that difference and the balance from before. And I'm probably going to guess it's a little bit of both. Burnaby will go up a bit, Surrey is going to go down a bit. So I believe that while interest rate is increasing, anything less than 2% increase will not really deter demand enough to come near to the supply level just to balance things out. However, like I said before, pay attention to your own region, especially if you are in those work from home popular region that has gone up significantly in the past 2 years. If you're thinking about buying in the remote regions, but the price starts to get very close to the popular regions, then maybe you want to think twice, because going forward, if there is going to be a rebalance, which is more likely, you could end up losing out money. So you have to do more research in those neighborhoods, talk to your realtor, and get a better understanding of your surroundings. Now, finally, let's talk about in terms of investment, real estate market. If we want to invest in either of them, how should we be approaching things this year? Now, because I do believe that rent is going to continuously trend upward, there are a couple ways that I'm thinking about if I want to get more exposure in the real estate market. The first one is to do pre-sale. In my opinion, pre-sale is a very good way to lock in your price 3 to 4 years ahead. I think if you're okay living in a condo, this is definitely not a bad option to look at, or townhome as well. Townhome is also a good way to lock in those price, but usually townhome gets built a lot faster, so you may not get that 3 to 4 year price lock. However, we have talked about this many times, there are much more risk going with a pre-sale because you don't have the final product. You have to do very good research on the developers' past performances, their reviews, their build quality, to really try to mitigate some of these risks. However, if you're looking at pre-sale for investment, I have said this previously, personally, I don't prefer this method of investing as much anymore, just because I'm now putting all my money into one specific building, which means that if the building has any problem, even though my area may have gone up, the building itself may have defects and affect my sale price or sale process. Plus, being in Vancouver, and maybe if you're in Toronto, you can probably tell that there's no pre-sale for investment available that can give you a positive cash flow, unless you're just putting a lot of down payment and borrowing very little, which then have its own risk because now you're putting a lot of your own money into one single place. Now, another way that you can also get exposure is something I also talked about, is doing REITs, which is real estate investment trust. This is also a good way to get exposure to real estate market without picking a specific building. But you have to be careful because as interest rate increase, these can affect REITs performance because they're most likely leveraged to buy different buildings so they can maintain a bigger portfolio. On the other hand, increasing rent can also help. So it really depends on the quality of the rental units and also the loan ratio of a specific REIT you're looking at. On top of that, there are many different REITs. Some are doing just commercial, some are doing residential, some is doing a mix. Personally, I prefer residential REITs a little bit more, just because as we can see, it's much less affected by COVID, no matter what happened to the market. At the end of the day, there's still a lot of people needing to rent. And lastly, in terms of investing in REITs, there is also a little bit of tax advantage for some REITs. And I can also do DRIP, so reinvest my monthly dividend or rent back into the fund, usually at a small discount. This can also let me grow my portfolio a lot faster and bigger. So if you're someone like me that don't like to spend too much time trying to manually manage my real estate portfolio or find all those expenses so I can report tax at the end of the year, then REITs is definitely a good consideration, but please make sure you do your thorough research before you buy into anything. Now, lastly, some other things is you can also consider some development projects out there. I have known clients that are doing this themselves. That's going to take a lot more work, a lot higher risk, but in exchange, may have some decent profits returning. For myself, I have these in very small doses, but they are nice hedges to my overall portfolio. Usually when I do them, these are more likely going to be private projects out there, so you need to do your own thorough research. Now, there are companies, especially the ones in US, that specialize in, for example, buying out existing rental complex, upgrading them, and then rent them back out at a much higher rental price so that it increases the overall value of this complex. And then maybe 4, 5, 6 years down the road, they will sell this complex to another buyer, and that's how we can exit our money. Now, if these things are done right, it can be highly lucrative, but do keep in mind that these things are long-term, very illiquid, and obviously can lose money if you're not careful. This, I would say, out of all three that I talked about, is probably one of the highest risk, takes the most research, and you should probably have the least money in there because of how illiquid and how risky these things are. Now, lastly, let's talk about investing in the market in general. Here, I'm just going to give the generic advice that I've always given no matter who's asking me, especially during these times. Number one is diversify in different sectors. Stick to blue chip or large companies. If you really want to try those tiny companies that have a chance to go 100 times if things work out correctly, do understand that you are very likely going to lose money instead of make money. Now, from personal experience and also my preference, you really can't go wrong if you stick with the mega company, the blue chip dividend paying ones like Microsoft, or maybe even banks if you want to go more conservative. And lastly, my advice is to not time the market and try to go all in at one time. If you're not sure, dollar cost average in can save yourself from a lot of emotional stress. So all you need to do is make sure you're well diversified, have a general plan, stick to it and ride it out, and make sure all your investment is according to your own risk tolerance. Alright, so this is everything I want to talk about this week. If you like what I've been saying, make sure you hit the like button for me. If you don't like what I'm saying, hit the dislike button twice. Next, what I want to hear from you is, what do you think about the stock market, the housing market, and interest rate and balance sheet runoff? I want to hear everything from you guys so I can learn from your perspective as well. And also, if you like these kind of videos, I do upload them 8:30 EST every Tuesday. So make sure you like and subscribe to the channel, hit the bell button to get all the notifications in the future. Alright, this is Jacky. I hope you found this interesting. I'll see you next week. Bye!